If you start studying finance, it won't take you long until you start hearing about the cost of carry. It's one of the most important concepts you'll learn in finance. And unfortunately, it can get pretty complicated. But if you understand just the basics of the cost of carry, you'll easily see that Bitcoin has a really tough road ahead of it. It's going to be really hard for it ever to be accepted. So let's start with a simple example first. Going for a walk might use up quite a bit of energy, especially a walk of something like 5 miles. But let's say I put a backpack on. Obviously that backpack, if it's heavy enough, is going to make it tougher for me to potentially complete the 5-mile walk. And that backpack is literally, I'm carrying it, right? It's costing me something to carry that backpack. It weighs down my body. It makes it easier to go, or more difficult to go longer distance. So that is sort of the basic concept of a cost of carry. And now we'll get a little more complicated. Even though if I'm wearing that backpack and it wears me down and it becomes more difficult for me to go 5 miles than without it on, there are some advantages, of course, right? I might get stronger over a long haul. I might get sick less. I might live longer because I'm exercising with some resistance, right? So the cost of carrying the backpack has some immediate short-term problems, but maybe some longer-term benefits. Okay, so now let's get more into like the financial world and commodities world and see how these cost of carry relationships work. You probably love Apple. You use all their products. It's an enormous company. It makes, I think, something close to $385 billion in revenue last year. I thought I read that, but don't quote me on that perfectly. And it's a great business, right? It buys back stock. I don't think it pays a dividend, but there's some sort of benefit from owning it, right? You know, it goes up. And if it doesn't pay a dividend, it does a buyback. I haven't checked yet recently. But here's the thing to think about, and this is where the cost of carry relationship comes in. If interest rates go up, like they are now, closer to 5%, that could weigh on my ability and my desire to hold on to Apple. Why? Well, if at 5% risk-free in a bank might actually be better than holding Apple stock. Okay, now we don't know this for sure, but the point is that the carrying costs are changing, and the risk-free rate, the interest rate, can affect the cost of carry. Okay, and that's a really important thing to understand with stocks. Okay, so you have to weigh the fact that you might get a better deal putting money in the bank than owning Apple, even though it pays a dividend or does stock buybacks, right? So there's two opposing forces kind of working one against each other, and that's how the carrying costs work. Now let's get a little more complicated. Let's say I'm a farmer and I'm growing corn or soybeans, or even I'm an oil trader, any kind of commodity. What's the problem with commodities, right? They have to be grown, then they have to be transported somewhere to be sold, and they have to be stored during that time period until they can be shipped somewhere. So that creates a really, really complicated situation between their future prices or forward prices, which can be traded, and their price today. And so traders are very concerned about these relationships and how they feed back into each other. But the point is, storage and the transportation costs something to carry it, right? It's a cost of carry. It's attached to the price, okay? And that's a very important thing to understand. So let's step back for a second and think about Apple. Now, Apple might be affected by some forces, especially interest rates and stuff like that. But it doesn't cost anything to actually store your Apple stock, right? That's stored on a little hard drive on your computer, and it's just a little piece of bits. So there's almost no storage cost with holding financial assets, right? Where corn or oil, you have to actually store a large amount of physical produced goods somewhere, and that really weighs on these complicated relationships. It feeds back into the spot price and feeds back into the futures price, and these are relationships that are really, really important. So what does this have to do with the whole crypto and Bitcoin ecosystem? Well, Bitcoin and crypto has some of the similar problems that something like commodities would have, right? They need to be mined. There's a miner to produce these things. Then there's a wallet that needs to be stored. And then they have to produce a huge amount of electricity to actively maintain these wallets. So it's a very much more cumbersome and clunky system, and it actually appears something more like a commodity market than actually would be something easier like storing bonds, on a computer. And as the U.S. government says, they can produce as much currency as they want, right? It's free of charge, it doesn't cost any storage, and they can conjure it up on a thin air. And that's exactly what we did during the COVID crisis to try and help the situation. So if we're trying to build a currency, an electronic currency that has a lot of storage costs, a lot of mining costs, and it's very clunky and it costs too much time to process transactions, it's going to have a very, very tough time competing against the current system, right? Which just sort of comes out of thin air, and that's both good and bad. Obviously, we now have an inflation problem, but in an emergency, we also probably want to be able to print some money or intervene when we can. And the crypto Bitcoin ecosystem won't allow that. So I think it's a pretty good chance that things probably won't stay around for this system. And at some point, it'll just go bust. Thanks a lot for watching.